Trade tensions between the US and China escalate, which triggers a stock market sell-off. But US bond prices rally and gold is up too on safe haven demand. And watch out today for trade data from China. That's coming up in our 5 Things in 5 Minutes on Monday, October the 13th. And then in our deep dive interview, ANZ Senior Commodities Strategist Daniel Hynes says China's stockpiling of oil has held up prices for now.
Whether they're willing to continue buying, I suppose, will be a key part of whether we see prices hold up or if we do end up seeing a bit of softness emerge over the next few months.
But first, in 5 and 5 with ANZ, Donald Trump has threatened to add an extra 100% tariff on exports from China, after China further restricted its rare earth exports. He's also suggested he might cancel a summit with President Xi Jinping due in a fortnight. Here's ANZ Group Chief Economist Richard Getzinger.
The first surprise was China's announcement of much broader control over its rare earths industry, effectively mirroring what the US had done on semiconductors. And they're kind of the two fulcrums of the negotiations that have been occurring. China has rare earths, US has semiconductors. Where would the balance be in reaching some sort of agreement? So the weekend's news is an escalation on an escalation from the US perspective, if you like, but unfortunately puts us firmly back now in watching what the two great powers will be in this tussle around tariffs.
The S&P 500 closed down 2.7% and the Nasdaq fell 3.6%. They were the biggest falls since April. The 10-year US Treasury yield fell 9.7 basis points to 4.051%. Remember, prices move in the opposite direction to yields in the bond markets. Gold rose 0.7% to $4,000 an ounce. West Texas oil futures fell 4.2% to $58.90 a barrel. More on that later. The US dollar index fell 0.6%. The Aussie dollar fell 1.3% to 64.72 US cents, and the Kiwi fell 0.4% to 57.22 US cents. Number 2. After Trump's threat, the ensuing slump in US stocks was, however, matched with a rally in US Treasury bond prices as investors sought safe havens. Here's Richard again.
With higher US debt levels, there's been a worry or a debate or even among some a view that the US bond market is less of a risk diversifier. Well, at least to close the week, we got some signals. No, it can still perform that role even with US debt levels there, and perhaps some kind of muscle memory from what's happened over the course of this year. Lots of tariffs on and tariffs off through periods of uncertainty, and actually the global economy and even the US economy has done okay, so that perhaps tempering the reaction. But certainly it looks like we're in for a few weeks of headline watching again, unfortunately.
Number 3. Richard says a deal between China and the United States, a type of grand bargain, has always been at the centre of hopes the global trade ructions could settle down.
The main interrelated issue is where will the US and China find some degree of stability, at least for a period, and that for a period clause is becoming even more important because over the course of 2025, one of the underlying questions in this whole tariff story has been, could the US and China reach some sort of grand bargain where they agreed to settling points on a whole lot of issues related to strategic competition? And based on the last week, you would say we're still quite some way from that.
Number 4. There were political dramas in Japan too over the weekend, which may affect the yen today. The governing coalition between the Liberal Democratic Party and the Komeito fell apart late on Friday over the appointment of Sanae Takichi as the new Prime Minister. The yen bounced, given the new PM was seen as dovish on interest rates and government borrowing, and the collapse is seen as watering down her power. But also there has been talk of intervention by Japan's authorities to stop the yen's sharp fall of the last week. Here's ANZ FX strategist Felix Ryan.
In terms of intervention, that's certainly become a topic of discussion again now that we've seen the sharp moves up in dollar yen this week. Look, generally the rule of thumb is a 10 yen rule. So what that means is if you see a lift in the dollar yen exchange rate from, say, 140 to 150, then that's more likely to incur intervention than not. I guess applying that rule, it does seem that maybe we aren't quite there yet, given we have moved from 147 to 153.
Number 5. In economic news out of China, we're expecting import and export figures for September later today. ANZ economist Vicky Zhao is expecting export growth of 6.6% from a year ago. That's up from the 4.4% in August, thanks to strong exports to other Asian economies and big demand for new versions of smartphones, the iPhone 17 and the likes. Import growth is expected to be slower at 1.8%, albeit up a bit from 1.3% the previous month. Here's Vicky.
Commodity prices have bottomed out, providing a slight boost to imports. However, the PMI import index remains below 50, indicating that the import recovery in China is not yet widespread. Anti-involution measures and capacity cuts in heavy industries are limiting the rebound in imports.
Vicky Xiaozhou there. Now, with that big drop in the price of West Texas oil futures below $60 US a barrel on Friday night, I spoke about a glut of supply in the oil market with ANZ senior commodities strategist Daniel Hynes. Just as demand may be softening, he says China has been a key buyer holding up prices until now.
It's really been the result of their buying over the past 6 months as OPEC started to increase its output. That has gone a long way to keeping prices relatively stable. The production increases from OPEC sort of in the vicinity of 2 million barrels a day, and it does look like China's essentially hoovered up most of that output, if not directly, obviously through broader sort of trade flows. And this is on the basis of developing its own sort of strategic reserves, something which it's put really at the top of its priority list now after a few years of energy disruptions and shortages that did cause issues across its domestic energy markets. So it's certainly been in the works for some time, and I think the softer prices and that additional supply hitting the market was the opportune time for them. I suppose the key question now, though, is whether they will continue that buying. We do get a sense that they'd sort of started to reach sort of limits of storage, but they do have a pretty aggressive pipeline of further storage facility development. So there's potential for greater sort of buying down the track, but whether they're willing to continue buying, I suppose, will be a key part of whether we see prices hold up or if we do end up seeing a bit of softness emerge over the next few months.
Yeah, and what's happening to supply growth outside of OPEC? Because particularly if these prices fall further, that's going to remove much of the remaining prospect of extra supply from elsewhere.
Yeah, and I think that's the issue which is really going to frame 2026. We've already sort of seen signs of these weaker prices on supply. The US shale industry is definitely taking a more cautious view. Its drilling activity has definitely slowed down, and the producers, certainly from recent surveys and sort of earnings reports, have suggested that the uncertainty has meant they're really holding back on any sort of additional investment, particularly on the drilling side for the moment. So we could potentially see a fall in production in 2026 if the drop in drilling activity continues through the end of the year. And I think if prices do push below $60 a barrel, we would start to see other producers, start to suffer outside of OPEC. So for me, prices below $60 a barrel doesn't compute with a significantly oversupplied market. So in the case of prices falling through this current quarter, I would suspect would see the reaction from the supply side in 2026, which would result in a little bit more of a balanced market. And look, I wouldn't just put that on non-OPEC supply. OPEC itself, I suspect, is unwinding the production cuts at the moment with the view that it may be able to reinstate some of those cuts in 2026 if conditions deteriorate. For example, demand ends up being weaker than expected with a downturn in the economic sort of activity. So, I think we could actually have prices sort of stabilising at these sort of current levels, and the supply side of the market offsetting weakness in demand in 2026.
Daniel Hynes there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Monday, October the 13th. Catch you tomorrow with the results from those Chinese export and import figures and India's consumer price inflation data, also due later today. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.